Have you ever just, you know, stared at those benefits forms, wondering what on earth a 401k or maybe a SEP IRA actually means for your future?
Uh-huh. It's a lot.
Or maybe you're just starting out first job, or you've even launched your own business. And the whole idea of retirement saving just seems, well, confusing, maybe even a bit overwhelming.
It absolutely can feel that way. Lots of jargon, lots of options.
Definitely. Okay, before we dive deeper, just a quick reminder that this deep dive is based on material from Farhat lectures.
Right.
All the content, examples, explanations we're talking about here, they're derived from the comprehensive accounting resources over at farhatlectures.com.
Great stuff there.
So whether you're an accounting student, CPA candidate, or a professional, you should check out the website for extra practice questions, video lectures, detailed support. Really helps reinforce today's topic.
It's definitely worth a look.
And special thanks to Professor Farhat for providing this valuable material.
Excellent.
Okay, so you're definitely not alone if you find this confusing.
Yeah.
This whole world of retirement plans, it is vast, feels overwhelming sometimes.
Yeah.
But today, our mission here, on the deep dive, is to sort of navigate that landscape. We're focusing on employer-sponsored plans today.
Good focus. That's where most people encounter them first.
Exactly. We want to pull out the essential bits of knowledge, cut through some of that confusion, give you a shortcut maybe to being well-informed about your options.
And maybe uncover some things people miss.
Yeah, hint at some maybe surprising facts and definitely some powerful tax-saving opportunities you might be overlooking right now.
Keyword there is powerful.
So let's unpack this. Why are there so many different plans? What's the big push, the incentive for you to actually save, especially through work?
That's really the starting point. Fundamentally, the U.S. Congress designed these systems. They want to encourage people, individuals like you, to save for retirement.
Okay, makes sense.
And they do that mainly through tax incentives, really significant ones.
The tax angle.
Yes. And these incentives, they apply across the board. Employees, employers, even if you're self-employed. It's about making it financially smart to plan ahead.
So it benefits everyone involved to participate.
Pretty much. And at the heart of almost all these plans is this core idea, the tax-deferred account.
Okay, what does that mean exactly?
It means the money you invest grows tax-free. So any interest, dividends, capital gains, it all compounds year after year without you paying taxes on it annually.
Wow, okay.
That growth isn't taxed until you actually withdraw the money, usually way down the line in retirement. It's a huge advantage for long-term growth.
That compounding effect without the tax drag sounds really powerful. And speaking of taxes, these terms pre-tax and post-tax contributions always pop up. Can you break those down? Why is that difference so critical?
Absolutely crucial. This isn't just like a small detail. It's about when you get your tax break. It's a strategic choice.
Okay.
With pre-tax, the money you put in today isn't taxed now.
Right.
So let's say you put $3,000 into a 401k. That $3,000 comes straight off your taxable income for this year. If your tax rate is, say, 30%, boom, you just saved $900 in taxes immediately.
Instant tax savings. Nice.
But the catch is when you take that money out later, including all the earnings it made over the years, that's when it gets taxed. Fully taxable then.
Okay, so tax break now, pay taxes later.
Exactly. Now, post-tax is the opposite. The money you invest has already been taxed.
So you earned $3,000, paid your $900 tax, and invested the $2,100 left over.
Precisely. You paid the tax up front, but here's the potential payoff. The original amount you put in comes out tax-free later. And crucially, the earnings can also be completely tax-free under certain rules.
Oh, wow, like with a Roth IRA.
Exactly like a Roth IRA, which, yeah, we should definitely cover in another deep dive. So with post-tax, you pay tax now, but potentially get tax-free growth and withdrawals later.
So it really comes down to, do you want the tax saving now, or do you want potentially tax-free income in retirement, maybe when your tax rate might be different?
That's the core strategic decision. Understanding that distinction is key to figuring out your long-term plan.
Okay, that clarifies a lot. So with those concepts, tax deferral, pre-tax, post-tax, how does this translate into the actual types of plans you might see from an employer?
Right. If we're talking employer plans, they generally fall into two really big buckets.
Okay.
First, you've got defined benefit plans. Think of these as the classic pensions. Your grandparents might have had one.
Right, the gold watch and the guaranteed check every month.
Kind of, yeah.
Yeah.
The benefit you get in retirement is defined. It's guaranteed, usually based on things like how long you worked there, your salary near the end. For you, the employee, this is generally less risky. The company takes on the investment risks.
They promise you a certain income.
Exactly. Then the second bucket, Defined contribution plans. These are way more common now. Things like 401ks.
Okay.
Here, what's defined is the contribution, how much goes in, either from you or your employer or both. But the final amount you get, that depends entirely on how well those investments perform over time.
So the risk is more on your shoulders.
Largely, yes. You bear the investment risk.
Let's dig into the first type then, the qualified pension. People might think they're gone, but they still exist, right?
Yeah.
Especially for some jobs.
Absolutely. They are less common in the private sector than they used to be, but they're definitely still around. A qualified pension means the company sets money aside with a trustee.
Not just in the company's bank account.
Critically important, it's separate, protected if the company runs into trouble. And if you meet the vesting rules, basically, work there long enough, like maybe 10 years for half a pension, 20 for a full one, like in that community college example, then you're guaranteed a certain income stream in retirement.
And that anecdote from the source material was fascinating, about getting a pension almost by accident.
Yeah, the adjunct instructor one, signed some paperwork teaching a couple of classes at a state university, didn't think much of it. Years later, takes a full-time job elsewhere, gets told no pension. Then, plot twist, 2 days later, a call. Actually, yes, you do have a pension. You were grandfathered in from that old adjunct gig.
Amazing.
Yeah.
It shows how these things work and that concept of vesting, earning the right over time.
Exactly. And it highlights why pensions are still common for, say, police officers, firefighters, government workers. Often that guaranteed retirement income is a major part of their compensation package, even if the current salary isn't sky high.
But they must be expensive for companies.
Very. They have to fund those future promises, put real money aside with that trustee. It's a big liability on their books.
Okay, you keep saying qualified pension. That sounds like IRS rules are involved. What does it take for a plan to be officially qualified?
Oh yeah, qualified is an official IRS designation. It comes with strict rules. First, it cannot highly favor the highly compensated employees.
Meaning the bosses can't just give themselves a sweet deal.
Pretty much. Owners, their families, people with 5% or more ownership, they can't get special, disproportionate benefits. It has to be fair.
Okay. What else?
Second, the plan has to benefit a good chunk of the regular workforce, at least 70% of the non-highly compensated employees.
So it's broadly available.
Right. And third, there has to be a clear vesting schedule. We talked about that 2 years, 5 years, 7 years, maybe. You know exactly when that benefit truly becomes yours.
And if a plan is qualified, what are the tax advantages? For both sides.
Big advantages. For the employer, the money they put in is an immediate tax deduction. That's huge.
Lowers their taxable income right away.
Correct. Plus, those contributions aren't counted as wages for payroll taxes. So the company saves on Social Security, Medicare, FUT, SUTA, those unemployment taxes.
Okay, multiple savings there. And for the employee.
For you, the employee, the growth, the earnings in the plan are tax deferred. You don't pay tax on that growth until you take the money out, typically after age 59 and a half.
Got it. And quickly, contributory versus non-contributory.
Simple distinction. Contributory means you, the employee, also put some of your own money in, like the source mentioned with their own pension.
Okay.
Non-contributory means the company funds it entirely. Like the example of their wife's J&J plan, she didn't contribute, the company paid for it all.
Okay, clear. Let's shift gears then to what's probably more familiar to many listeners.
Yeah.
Profit-sharing plans. And the big one, the 401k.
Right. Profit-sharing plans are also defined contribution. The key difference is the company's contribution is usually discretionary. They decide each year, often based on profits.
So more flexible for the company.
Very much so. Good for smaller businesses, maybe? If profits are down, they might not contribute that year. It can also help tie employee motivation to the company doing well. Usually, employees don't contribute to these.
And then the 401k. Why is it just everywhere? Is it just the name?
The name helps, maybe,
Yeah.
but it's really just named after the IRS code section, 401k.
Yeah, okay, not very creative.
Not at all. But its features are why it's so popular. First, contributions are usually pre-tax. That immediate tax break we talked about. Put in $10,000, save maybe $2,000 or $3,000 in taxes this year, depending on your bracket.
That's appealing.
Very. Second, the money grows tax-deferred, compounding without taxes until retirement. Third, there are contribution limits, but they're pretty generous and they go up over time, plus that catch-up amount if you're 50 or older.
Right, you can put in extra.
And fourth, and this is huge, employers often match your contributions. up to a certain percentage, maybe 3%, 5%, 6% of your salary.
That's the free money part people talk about.
Literally free money. If your employer offers a match, contributing enough to get the full match should be your absolute top priority. It's an instant guaranteed return.
Makes sense. Are there limits on the total amount going in?
Yes. There's a combined limit for your contribution plus the employer's contribution. That also gets adjusted. And like pensions, 401ks have to follow non-discrimination rules.
Okay. So the money's in there growing. Is it totally locked up until you're 59 and a half? What about emergencies?
Generally, yeah. The idea is long-term savings. Taking it out early usually means paying income tax on it, plus a 10% penalty.
Ouch.
But there are exceptions. Plan termination, if you leave the company, death, disability, those are standard ones. And there are also specific hardship withdrawal provisions.
Like for a medical emergency or buying a house?
Sometimes, yes, the rules can be specific, and they've even been loosened temporarily during major crises like the 2008 housing crisis or, more recently, COVID, to allow people access in real emergencies.
Good to know there's some flexibility, even if it comes with costs. And 403B plans, you mentioned those.
Basically the same animal as a 401k, just offered by different types of employers, typically educational institutions, hospitals, nonprofits, other tax-exempt organizations. Same pre-tax contribution, tax-deferred growth, similar rules.
Gotcha. And you had that W-2 example.
Right. Just illustrate the tax shield. If you earn $80,000 and put $2,400 into your 401k, your W-2 might show taxable wages for income tax as $77,600. But your wages subject to Social Security and Medicare taxes would still be the full $80,000. The benefit is on the income tax side. And that $2,400 contribution would also be noted on the W-2.
Clear. Okay, but what if you are the company? You're self-employed or a small business owner. You need to save too. What about things like KOH, SEP, Simple?
Absolutely critical for that group. And yes, there are specific plans designed for them.
Let's start with KOH. Sounds a bit old school.
It is one of the older plan types for the self-employed, yeah. Subject to similar kinds of limits as other qualified plans. The key contribution limit is the lesser of the annual max dollar amount, which was $57K back in 2020, it adjusts, or 25% of your earned income.
Earned income. How's that calculated?
That's where it gets a little tricky for KOGHs. It's your net self-employment earnings after you deduct 1/2 of your self-employment taxes and the KOGH contribution itself. It's a bit circular.
Okay. Needs calculation.
Definitely. But the bottom line is it allows self-employed people to put away a lot of money pre-tax, potentially tens of thousands a year, significantly cutting their current tax bill.
Okay. Powerful if you can navigate the calculation. What about SEP? Simplified Employee Pension.
SEP IRAs are often simpler, hence the name, also great for small businesses and self-employed folks. Here, the employer sets up an IRA for each eligible employee, and only the employer contributes.
The employee doesn't put money in.
Not directly into the SEP, no. The employer contributes usually a percentage of pay, anywhere from 1% up to 25%, and they have to contribute the same percentage for everyone eligible.
Who's eligible?
Generally, someone who's worked for the business in 3 of the last 5 years and earned a minimum amount like $600 in a year. It functions like a 401k, pre-tax money, tax-deferred growth. Max contribution limits are also high, similar to 401ks.
Seems pretty straightforward. And simple plans.
SIMPLE stands for Savings Incentive Match Plan for Employees. These are specifically for smaller companies, fewer than 100 employees that don't offer those other types of plans, like pensions or profit sharing.
Okay, a niche for the small guys.
Exactly. And the key difference here is that both the employee and the employer contribute. The employee can contribute up to a certain limit, $13,500 in 2020, plus a catch-up if you're 50 plus.
And the employer?
The employer must contribute too, but they have 2 choices. Option 1, a 2% non-elective contribution. Means they give 2% of pay to all eligible employees, whether they contribute themselves or not. Option 2, a dollar-for-dollar match on the employee's contribution, up to 3% of the employee's pay. But they only pay this match for employees who are actually contributing.
So, different ways for the employer to participate. Who's eligible for a simple?
Generally, you need to be 21, have earned at least $5,000 in the last 2 years, and expect to earn that much in the current year. One unique rule for simples. There's a special 2-year waiting period. You generally can't take money out penalty-free for the first 2 years you're in the plan, even if you're over 59 and a half.
Interesting wrinkle there. So it really shows there's a spectrum of plans tailored for different sizes and types of businesses.
Definitely. From huge corporations down to one-person shops. But the underlying goal is consistent. Use tax incentives to get people saving for their retirement.
So wrapping this up, we've really taken a deep dive today. Covered a lot of ground from traditional pensions, defined benefit,
Right, those guaranteed income streams,
to the much more common defined contribution plans like 401ks and 403s.
where the contribution is known, but the outcome depends on investments.
And then we looked at those specialized plans for the self-employed and small businesses, KEOGH, SEP, and Simple.
Yeah, unpacking how the tax rules work differently, pre-tax now versus post-tax later, tax-deferred growth, and the specific features of each one.
It feels like understanding these distinctions is really the key. It empowers you, the listener, to make informed choices, whether you're looking at your company's options, or maybe you are the company setting one up, or you're flying solo as self-employed.
Absolutely. And connecting this all back, we saw the qualified pension, the flexible profit sharing, the workhorse 401k, 403b, and then KEOG SEP, simple for smaller operations. Each one is a different tool, a different path, but they're all built on that foundation of tax incentives designed to help build a more secure financial future.
So, knowing this, it does bring up a final thought, doesn't it?
It does. Thinking about your own situation, your own financial picture, and what you expect down the road. Which approach resonates more with you?
Yeah. Are you prioritizing getting that tax break right now, lowering your current taxable income as much as possible?
Or are you perhaps more drawn to the idea of paying the tax now, maybe while you're in a lower bracket, for the potential of completely tax-free growth and, crucially, tax-free withdrawals in retirement?
Immediate savings versus long-term tax freedom. It's a big strategic question.
Definitely something to chew on.
And that's something for you to mull over as you continue your own deep dive into financial planning.